What if you could read a business like an open book? Imagine having the power to instantly understand any company's financial health, to see past the surface and know exactly what's happening behind the scenes. That's not just for accountants anymore.
Huh?
Three things you would instantly know: what the business owns, every resource from cash to buildings that provides future value, what it owes, all the debts and obligations the company must pay to others, and how financially strong it is, the real picture of stability and owner wealth in the business. That tool exists. It's called the balance sheet. And by the end of this presentation, you will know exactly how to read it. No accounting degree required, just clear, practical knowledge that puts financial power in your hands. What is balance sheet? A financial snapshot at a single moment in time. Think of a balance sheet like a photograph, not a video. It captures the exact financial position of a company at one specific instant, like freezing a moment in time. Example, as of December 31st, 2024. Unlike income statements that cover periods, quarter, year, the balance sheet is a snapshot of that exact day. The three components. These three questions map directly to the three main sections of every balance sheet. Assets, resources owned by the business that provide future economic benefits. Liabilities, debts and obligations the company owes to creditors and others. Equity, the owner's residual claim on the company's assets after liabilities are paid. Assets equals liabilities plus equity. This equation must always balance. That's why it's called a balance sheet. What are assets? Definition: resources owned by the business that provide future economic benefits. Assets are what the company owns. Anything of value that can be converted to cash or used to generate revenue. They are listed on the balance sheet in order of liquidity, how quickly they can be converted to cash. Example of assets. Companies own many different types of assets, from cash in the bank to buildings and equipment. Cash, money in bank accounts and physical currency. Equipment, machines and tools used to produce goods. Vehicles, company cars, trucks, and transportation. Buildings, real estate and structures the company owns. Inventory, products ready to sell or raw materials. Accounts receivable, money owed by customers for credit sales. What are liabilities then? Definition: obligations the company must pay in the future. The key point: money or services your business owes to others. Let's see the common types of liabilities. It can be bank loans, money borrowed from financial institutions that must be repaid with interest. Accounts payable. These are the short-term obligations to suppliers and vendors for goods or services received. Salaries payable. Wages and compensation owed to employees that haven't been paid yet. Taxes payable. Income, sales, or payroll taxes your business must remit to government agencies. Equity. The owner's true stake. Equity represents what would remain if you sold all assets and paid off all debts. This is the real value that belongs to the business owners. The formula says equity equals assets minus liabilities, always. Some examples of equity. It can be owner investments, money or assets the owners put into the business. Retained earnings, profits kept in the business rather than distributed to owners. Share capital, money raised by selling ownership shares in the company. Let's build a balance sheet from scratch. A simple single owner business. 3 transactions, 3 slides. No prior accounting experience needed. We will watch the equation assets equals liabilities plus equity hold true at every step. One company, a single owner startup with no history, 3 transactions, each one changes the balance sheet, and we will see always balance. The equation never breaks. See why. Step 1. Owner puts in 20,000 euros. The owner invests personal money into the business. Cash goes up. Equity goes up. The sheet balances immediately. No debt involved. So on the left side we have 20,000 euro cash. In the middle we have still nothing. And on the right side we have 20,000 euros owner equity. So 20,000 euros assets equal 0 liabilities plus 20,000 euros owner's equity. The formula is balanced. Let's see step 2. Company takes a 10,000 euro bank loan. What happens? More cash arrives, but so does debt. Assets grow, liabilities grow. Equity stays untouched, but the equation still holds. Let's see. Now we will have 30,000 euro cash, in the middle 10,000 euro bank loan, and on the right side the equity doesn't change. So let's check the formula. 30,000 euros assets equal 10,000 euros liabilities plus 20,000 euros equity. It's balanced. Let's check then step 3. Company buys equipment for 20,000 euros. What happens? Cash converts into equipment. One asset trades for another. Total assets hold steady. No new money entered or left, so the sheet still balances perfectly. On the left we have 10,000 euros cash left and 20,000 euros from them transferred into equipment. In the middle we still have 10,000 euros bank loan, and on the right we don't have any change in the equity. So 30,000 euros assets equal 10,000 euros liabilities plus 20,000 euros equity. The equation balances perfectly. Okay, let's take a quick quiz. If you buy a new 5,000 euros laptop for your office using a credit card, I want to say not by cash, what happens to your balance sheet? Answer A. Only your assets go up. B. Nothing changes. C. Both assets and liabilities go up. Think about it for a moment before scrolling. And the answer is C. And why it matters. You buy a laptop for 5,000 euros. You increase your assets, but you don't buy it by cash that you already have. You buy it with credit card debt. So your liabilities increase as well with 5,000 euros. Your equity remains unchanged. Why does it matter? Your net worth stays the same, but your debt just grew. If you only track what you buy, you will never see the invisible debt that's quietly killing your growth. Let's check how our balance sheet changes. You buy the 5,000 euro laptop equipment using a credit card, not cash, and your total assets are right now 35,000 euro. Your total liabilities grow as well with 5,000 euros, and you have 15,000 euros plus the 20,000 euros equity, and again we have the formula balanced. We covered a lot today. Let's make a quick balance sheet basics recap. 3 rules to anchor your understanding of every balance sheet you will ever read. First, the golden rule. Assets equals liabilities plus equity. Always. This equation always holds. No exceptions. It's the foundation of every balance sheet. Assets, remember, this is what the company owns: cash, equipment, inventory, resources with future economic value. In our next lessons, we will gonna deep dive what exactly are the assets. Liabilities, what the company owes: loans, accounts payable, obligation to outside parties. Again, we will dig down further in our next lessons what exactly liabilities are. Equity, what remains for the owners after all debts are settled, the true residual value. The balance sheet captures what a company owns, owes, and what belongs to its owners at a specific point in time. Remember the snapshot from the first slides. I'm Danny A from Accounting 123. Accounting explained for real people. You've got this. Well done. You can download your cheat sheet to keep these concepts handy. Please subscribe so you won't miss any lessons. And the next lesson is about the income statement. Master the next piece of financial statements. Accounting 123, making financial literacy accessible. Keep learning, keep growing.